Welcome to the daily update. This is being prepared Wednesday, June 29th, where we'll look at the action in the market today and then see how things look for Thursday, June 30th. And it turned out to be a really boring day. Before I get into that, I apologize for the sound quality in yesterday's video. I forgot to hit a button to change the microphone, and it ended up being my external microphone, which a lot of you may know that's usually not a very good quality microphone, but I just didn't have time to go back and re-record the video. So I'm sorry about that. I double checked the button today, so it should sound a little bit better, even with my coughs and tripped over words and bumbling statements. But let's go back and talk about what happened on Wednesday. It was pretty boring. My goodness, we had a lower open. The futures were lower as we went into the session. And then we just spent the day chopping above and below the unchanged level. That's pretty much all that happened. We didn't hit an R level. We didn't hit an S level. We didn't even really do much of anything. So going into the close, we were virtually unchanged, but we ended up being down 0.07%. Volume was below average, and we're really seeing things slow down right now. Of course, the technicals, they're still negative. We have some potentially positive things in the background, but they're not really playing out all that well right now. Now, they could improve, but we just have to keep an eye on these things as they develop. Inflation and interest rates, which produce growth concerns, that's the big fixation for the market right now. We have a whole list of geopolitical concerns which could come to the forefront. Earnings as each company releases them, and then we're dealing with, are we going to go into a recession or are we not? That's the big debate going back and forth. So June 30th, so Thursday will be the last day, not only of the month, but it's also of the quarter. So you might see some rebalancing or some what they call window dressing. There might be an increase in volume because of being the last day of the quarter. So just be aware of that. What happened on Wednesday was that the Cleveland Fed President, Mester, who's a voter on the FOMC, said that she would support another 75 basis point hike in the July meeting coming up at the end of July if conditions stay the same as they are right now. Also in Europe, Fed Chair Powell said that fighting inflation is worth the risk of slowing economic activity. And that's kind of the same narrative that we've been hearing all along, that getting inflation under control is the number one goal, even if it does slow down the economy for right now. The 10 to the 5 yield curve is still inverted. Fear is now tipping back into the extreme category. And the reports that came out, we had another release of the first quarter GDP. This was the third estimate, and it came in at minus 1.6%. And I have to clear my throat. They expected it to be down minus 1.5%. So it came in a little bit weaker than expected, but not a big surprise. This is the third report that we've received on this GDP. So it didn't really catch the markets off guard all that much. There's also a deflator, which basically measures inflation. And its estimate came in at 8.2. They expected it to come in at 8.1. So the GDP was a little less stronger than they thought because it was down 0.1% more, but inflation was up 0.1% more. We had the weekly MBA mortgage applications index. It was up 0.7% for the week. Our trend is negative and still weakening overall. We're not getting a lot of market movement right now, so that tends to bring the ADX down. I've switched our bias over to negative. We just are that way right now, even with the slightly down day, even with the possible positive backdrops or setups that we're seeing, those aren't really strengthening right now. They're not necessarily getting any weaker, but we just kind of have to shift everything over to negative because that's what our charts are telling us. And our momentum is still mixed, but you could probably lean that over into the negative category as well. Let's go back and talk about the day's session. We did tick into the 25 range, which is the extreme fear. And this just shows how we're declining a little bit based on that. We're seeing the Chicago Fed National Financial Conditions Index. It's continuing to tick up a little bit more. We're not at the black line yet. As long as we're below this black line, things are okay, but we are showing a real increase. And you can look back at other times when this really spiked above the black line, and there were typically some bad economic things that happened at that time. Also from IsabelNet, this just shows the percentage of US Treasury yield curves, and they inverted these, so they're upside down. And these are all the different yield curves that we look at. And when they get to 50% or higher, that usually means that things are going to be pretty bad. Well, even with the inversions that we've seen, and even the ones that the market likes to focus on the most, we're still up just a little bit over 30% of the yield curves that we look at on a regular basis. So that hasn't really spiked up yet. Looking at Treasury yields, Goldman Sachs is coming out, and this is their forecast for what they think the 10-year interest rate will be. First at 3.3%, then down to 3.15, and then it will finish out 2024 at 3.15. And this changes all the time. So they constantly adjust this forecast as we go along. This shows the Fed funds futures spread between April 2023 and April 2024. So we're looking well out into the future. And we're seeing a real decline. So this could suggest that interest rates will start to come down in the future. That doesn't really help us right now, but the market looks forward. It likes to look at these things and then price that into the market as we go along. This is the seasonality, and we are in this is what they have here is a presidential year cycle in the second year, and it goes all the way back to 1928. How does this year usually unfold? This is a midterm year. So it shows each month starting over on the left with January, and we typically have an up month then. And then as we get further along, May and June are usually fairly negative. July and August turn back to positive. Then we have a pretty rough September. But then what will happen as the midterm elections get clearer, things tend to get more optimistic. There's change in the air. There's an election happening. There's things that people are optimistic about. And so a lot of times the market will pick up during that time. Then this is the cyclicals. Now, these are the other areas that do move more with the economy against the defensives. The defensives are the things that those are what you need no matter what's happening in the economy. And according to this chart, it's sending a less optimistic message on growth. And they're saying yields are really where you should be right now. If you're getting dividends or if you're in some kind of yield-based investment, where the blue line is just showing the cyclical to defensive ratio. And it has really been declining lately, even though it spent a lot of time going up. But now we're seeing some recent weakness where the 10-year Treasury yield, it is actually outperforming. So they're suggesting by this chart that interest rates are going to go higher. And if you can get into an ETF or something like that, that is based on interest rates, you probably would see better returns that way. Then this is a model showing the median S&P 500 company year over year. And this is expenses before interest and taxes. This is just showing how these things are going, where the actual is the black line, where we really spiked up and now we're coming back down, but they do expect it to go back up. The model suggests that once we spiked up and came back down, we should continue to go lower. So this is actually looking a little bit more optimistic. Then the economic output composite index is showing a decline right down here, the blue line, which is the LEI. That's the leading economic index or indicator. It is declining. And the economic output composite index is also declining. So that's just showing that there could be a slowdown in the economy. And once this drops below zero, a lot of times that's when we end up seeing a recession. Those are the grayed areas on the chart as well. This is just showing the purchase only house price index. That's the purple line here. This is what you're going to have to pay. And this is what people are making, the average hourly earnings. And can you see a real chasm between the two? And this may bite into the real estate market and probably already has. The last time we saw this was what we call the housing bubble. And then it really came back down. Well, are we in some kind of a housing bubble again? We don't really know that now. We can just look at this information and go, things are kind of out of line right now. Then the cumulative flow, and this goes outside of the US, where most of the money coming into the market is from the US. And then the lighter blue line is Europe. That's kind of down here at the bottom. The darker lighter blue line, if you want to go with that, is Asia. And then the gray line is the EM, emerging markets. So it's just showing that the US still has the most inflows around the world. This is a way of looking at earnings. And really what we're taking from this, here's the 2022, where they've been increasing the EPS estimates. Well, it's starting to flatten out right now. And it's also starting to flatten out for 2023. If you look at the end of this line, could that be some problem in the future if we start to see these lines coming down? That just means they're lowering their earnings per share estimates. And the market will usually price that into the market by going down. Here's a Yardeni chart just showing the VIX against the Investors Intelligence Survey, which I talked about in yesterday's video. And it just shows that there's a pretty strong correlation between the two. When fear gets higher, that's when people are not as positive on the market. When this gets lower, people are more positive on the market. This is showing the VIX against the high yield. Sometimes you might call these junk bonds. This is the corporate bond spread. This is the one chart that I showed, the spread between the risky bonds and the not so risky bonds. And it just shows how the VIX and this spread tend to go in tandem with each other. And we've been seeing it start to climb a little bit as the market has been going down. Then this is the economic report that came out, and this has two readings on here. The dark blue line is GDP, which is showing that right now it looks like we're going to be down 1.6% here. And then the deflator, this is measuring the inflation, where it has been increasing. So we watch this, we watch the PCE, and we also watch the CPI to get some idea of what's happening with inflation. Here's just showing real GDP on a year-over-year basis. We're still positive overall, according to this, but we are declining. And then this is the shadow stat site showing that we're just seeing a discrepancy here between the official number, that's the red line, and they've come up with their own version of this right here, which suggests that we might already be in a recession. So let's go back in, look at the VIX. It came up a little bit on a down day, but it was virtually unchanged on the day. But the VIX still, it actually declined just a little bit. And the VIX of the VIX is actually showing a little bit of a decline. The ulcer index is starting to turn back down now. It's not showing that extreme fear reading that we were seeing before. We're down 20.75% from the all-time high. The equity put call ratio did go up on the daily chart, and it's still going up on the 5-day chart. The bear bull ratio came up a little bit to 0.10 in the latest reading. And this is what I thought was interesting. I usually don't show this chart until I do the intermarket analysis video each week. We're starting to see a death cross looking at value. That's kind of interesting. Value has been the big leader in 2022 overall, but we're starting to see that we could be moving into a downtrend. Doesn't mean growth is doing any better, but we are seeing some weakness in value. Support and resistance, here are the daily pivot levels for Thursday. And here's the daily chart showing that we're down below this pivot point and really didn't have much to show for the day. And I tried to add some more space over on the side to see if this might be any more. To me, this is not a useful chart. I just see a whole bunch of lines and smeared numbers, and this really doesn't help me, but let me know if this helps you or not. And this is supposed to be a cleaner version of that chart. And I also added some more space over here, but this can be a little bit hard to see because where they have the pivot levels plotted is right over top of the bars. The short-term fib level, we're still above that. When we set the high in March and the low back in May, we dropped below it, came back above. We're still slightly above that 100% retracement level right now. And here's the update of the daily pivot points, which they will readjust again with July. The fib retracement going back to the 2021 low, we're still above that level. I should have moved this round thing over to here. And here's the fib levels that are, to me, kind of more important. We're pretty much right on top of the 61.8 and 38.2% retracement. We're just right at this level right now. So that just means the markets are pretty indecisive. They don't know whether to really go up or down. Incidentally, when I started recording, the futures were down pretty significantly. I'm not sure, down over 1%. So we'll have to see what happens with all of that. Here's the longer term chart showing that we're right at the 38.2% retracement level, where this is showing the 200-week moving average. So we still have that support down below us if prices keep falling. Here's the sectors showing that energy and materials and real estate did the best on Wednesday, and those that, did the worst. Since it was a down day, these are organized according to what did the worst. There were a few that were positive: communications, staples, and health sector, but nothing really major. Really, the energy sector is the only one that moved, and it was down almost 3.5%. And then this is the scooter rating, showing that the scooter chart looks the best, followed by utilities and staples, and healthcare's still looking okay. You've got a bunch that are in the middle, where communication and discretionary, they're both under 10 as far as their reading. And this is just the same chart that we've been looking at, showing energy in the lead, the rest of these sectors negative since the all-time high. Technical alerts, most of them were negative. Really nothing for the S&P other than we crossed below 3,800, but kind of a mishmash there. Here's the futures before we opened, and I was a little bit late where you're seeing all this gyration around. That's the open, but the futures were slightly positive, then they drifted negative, slightly positive, negative. They were chopping around as well. And this is the intraday chart where we gapped down. We had a lower open, not really a big gap. So I just say a lower open. We came back up to the unchanged level, danced across that, and just spent pretty much the rest of the day not too far from the unchanged level. Our trend just shows that selling is increasing slightly, buying is decreasing, but we still have an ADX that is declining, but it's still above 20, so it's a negative trend. The Arun has not changed in quite a while now. Even though selling and buying are decreasing, they're kind of canceling each other out, so we're getting a flat oscillator. Looking at breadth, a little bit of decrease based on price and volume. And the advanced decline ratio is now down below 0, so that is negative. New highs and new lows, they're still positive, but if we don't see some strength internally, this is possibly going to roll over. Accumulation distribution is just about right on top of the moving average. Short-term charts were at the bottom end of the short-term rainbow. The force index really had no change. It's just about at the unchanged level. Swindlam trading oscillator is still showing a bit of a decline based on price and volume. McClellan oscillator has turned slightly negative now. It dropped below 0. And we saw a little bit of a decrease with our 20, 50, and 200 period moving averages. The short-term stochastics, they tried to turn up ever so slightly, but they're still negative. They're rolling over more in the intermediate term, and they're rolling over a little bit, but still positive with the long-term stochastics. The PMO continues to be positive. We've crossed over based on price. We haven't quite crossed over yet based on volume. Those that are rising continue to fall after giving an extreme positive reading. We're still advancing with the buy signals, and we're turning up to flat with those that are above zero. Chaikin oscillator continues to decline, but it's still above zero. So it's negative that it declined, but positive because it's still above zero. Chaikin money flow just kind of dancing sideways right now. Volume intensity continues to show that we're declining because we're seeing a real drop off in volume. The vortex saw a bit of an increase with selling and a decrease with buying, so it's negative overall. Summation index is starting to turn down based on price and volume. Our oscillators, though, we have the slope, the MACD positive. The KST and tricks look like they might turn positive, where the PMO has already turned positive, as has the TSI. So we're still kind of a mixed bag with our oscillators, but they are showing something positive. The BPI, it declined just a little bit, but not very much on Wednesday. The rate of change is still extreme negative, going back 50 periods. The ease of movement is also declining. Our TTM squeeze also showing a little bit of improvement, even on a down day. Looking at our charts, the Heikin-Ashi redrew, and now we have a dark candle. The Kegi chart is still positive because it's black and on top. The Renko is still looking more negative. The Elder Impulse system is still neutral with the SPX and with the SPY. The SAR continues to be positive. There's another little dot underneath the bars. Our go, no go system is still a negative neutral with the lighter shade of purple. Long term, we saw a bit of a decline with the 50, 150, and 200 period moving averages. The rate of change going back 200 periods shows a little bit of a decline. And here's a longer term chart after hitting that extreme negative reading, but it's just not bouncing any higher currently. The special K continues to be negative. Looking at the broad market, the diamonds are still neutral and the Qs are still negative. The VIX showed a little bit of a decrease with the bar chart and the line chart. So we're not seeing a real spike up in fear right now. Looking at the S&P with those stocks above their 50-period moving average, we came back down a little bit, but we're trying to see if we can bounce up after giving an extreme negative reading. And here are the mid caps showing the same thing, and the small caps. Also, the dollar, it was up over 0.5%, so it's still in a pretty significant uptrend. The dollar to the S&P 500 is now back to neutral. Oil was down 1.77% to 109.78, and the correlation between the S&P and oil is still slightly inversely related to each other, but getting back more towards neutral overall. Bonds saw a little bit of an uptick with the corporate bond index, a little bit of an advance with the treasuries, and the world index was up almost 0.5%, but not a real big move. The bond market was almost as boring as the stock market on Wednesday. The correlation between the S&P and the 10-year yield, it still has an inverse relationship, but it's just kind of moving sideways. It ticked down a little bit. Here's the tech sector to the 10-year yield, getting back more towards neutral, but still having an inverse relationship. The 10 to the 5 yield curve is still inverted, and it just shows where interest rates went down pretty much across the board on Wednesday. Our positive scenarios, possible positive scenarios, we're seeing the Copic curve. It could be generating a signal. Now, this doesn't tell us what direction. It just means that something big might happen. But there are times when we get false signals from this. There are other times when we get good signals from this. So we just want to keep an eye on this. There's no other signals that we're getting yet. We're still working off this idea, though, that after we spiked up with the equity put call ratio based on 5 periods, but it's really not doing much yet here. The stocks that are above their 200-day simple moving average after getting almost extreme really isn't showing us much. Now, we're seeing kind of the same thing. It's right along the moving average when you look at our rotation charts, where we've gone back right to the moving average with the Qs. Discretionary is pretty much flat, and the large cap growth to large cap value is also just slightly above the moving average. Looking at growth and value with the large caps, right on the moving average, a little bit of an increase with the mid caps and kind of flat to a slight decline with the small caps. So this isn't really giving us any strong signals right now or strong information. Are we spiking up? Well, again, it's hard to tell. We spiked up and now came back down a little bit, but will it stay that way? The correlation between the S&P 500 and the 2-year yield, it's still having an inverse relationship, but not really strong right now. We're getting nothing from the small cap ratio to the S&P 500. We want to see a little spike up on this red chart. We're just not seeing that. The sectors, they were up, so that helped the sectors a little bit, but that made this spike up just a little bit overall. Are we going to take out this other spike? We're just waiting to see what will happen here. So what's our outlook? As far as our technicals, we have some possible positive setups, but they might go away if we don't see follow through price action, if we don't see more internal action to support those scenarios. Sentiment is back to being extreme negative. We have personal income and spending coming out on Thursday and the PCE price index. So we'll want to pay attention to that. And then jobless claims, which come out every week. We also have the Chicago Purchasing Managers Index coming out, or PMI. And then all the different geopolitical events. And I feel like a broken record here. Russia, Ukraine, China, and supply chain issues. Inflation and interest rates, which are the same things that we've been freaked out about. Margin calls if we really start to fall. We want to watch oil because it's still very high. Earnings as they are released. We did get some Fed speak yesterday, but it didn't really have much of an impact or didn't really change anything from what the markets already know. The longer term situation in Japan, which is why their interest rates are still so low. And then the big recession debate. Are we going to go into a recession? Are we not? That's kind of the big thing that everybody's focused on. So our scenarios, will we keep going down from here? Well, all this whole list suggests that, yeah, we just might keep going down. And our technicals are just not showing much improvement. Now that could change with a solid up day, but we have to go with what we see right now. Go up from here? Well, the technicals really need to improve in order for that to happen. And there is a disbelief that the market will go higher. And a lot of times the market works opposite of what most people think. These possible positive scenarios and the sector rotation, is that actually happening? Yeah, it was happening before, but we're not really seeing a lot of follow through right now. And then our technicals are just not helping us on the positive side. So we look at pivot points, fib retracements, and then previous highs and lows that might provide support or resistance. And some might say that we are sideways because we have a declining ADX, but it's still above 20. So my stance is that we are in a negative trend that is weakening. So our conclusion then is the S&P is negative, but is it actually rotating back to growth? Doesn't really look that way right now, but that could change. Short term, we're negative, but are we seeing an improvement? We were, but we're not really now. Same thing with the intermediate term, where long term, we are still negative. So thank you. Have a wonderful Thursday. I will prepare Friday's video after Thursday's session, and I hope everybody has a great day.